Shall we get started? I am Peter Hewitt. I'm a client director at FiscalReps, and a client here, Martin Lapelli, who is compliance director at Heritage Insurance Management in Guernsey. We're going to do a bit of a double act, and this arises from a project that FiscalReps was asked to do for Heritage, to give some guidelines as to how VAT applies to claims costs for captive insurers in particular. The rules that we're going to talk about do apply to any insurer, so it's not just captives. But we're going to talk about the VAT in the context of a captive insurer in Guernsey and a parent insured in the UK. And obviously things do get more complicated than that because captives can write business in all sorts of different countries. But let's start with the basics and just point out the rules that should be considered in terms of VAT. To start with, I'm going to talk a little bit about the background of VAT and how it's accounted for. Martin will cover that. And the sort of captive costs that we can expect. So what are we looking for VAT on? And then the way that you should structure the actual policy that a captive will write, and issues that need to be considered in that context. And then finally, if we've got time, we'll have a couple of practical examples just to show exactly how this should apply in practice. So VAT is, as you probably know, a tax on supplies of goods or services, and obviously it exists in most countries in the world. Certainly every country in the EU is required to have a VAT system as a condition of membership of the EU. The rates can vary, and the rates applied to different goods and different services are different in different member states. Mainly the same, but not entirely the same, as you'll see, particularly with claims handling when we come on to talk about that. So the basic rule is that if you are in business and you're making supplies of goods or services, if they're taxable, you have to register for VAT. If you're an insurance company and you're making supplies that give you the right to recover VAT, then you register to get your input tax back. And supplies that give you the right to recover VAT are those that are made to customers or insureds outside the EU. So premiums received from non-EU policyholders. Insurance itself, if it's within the EU, is exempt, which is quite unusual. And you've heard earlier that Peter Winterskill and the IUA would like to have VAT on insurance premiums rather than have exemption, which is more common in the Asia-Pacific region, and we'll be talking about that this afternoon in a bit more detail. But in the EU it's exempt, and that means that you aren't eligible to recover the input tax on supplies of goods or services that you buy in. So if you have a claims cost and it's incurred by the insurance company, the VAT is part of the claim. It's not recoverable from HMRC. So that's the critical point. In terms of EU VAT, it's governed by a VAT directive in the EU. As I said, that should give you the same rules for VAT in all the member states, but in practice it doesn't. The directive has to be implemented into national law, and in the UK that's done by the VAT Act of 1994. The directive has got a later date because that's just a compilation of earlier directives, so the rules that are in the VAT Act were always the same, and the VAT directive is the same as earlier directives. Place supply rules, importantly, were changed on the 1st of January 2010, and that's the main reason why there's a bit of confusion as to what supplies are subject to VAT and what aren't. So we'll go into that in quite a bit of detail. Most services, the basic rule for services is that they're subject to VAT where they're received, so where the recipient of the supply of service belongs is established. And that's the important point. Where captives are established, very often there isn't a VAT regime. So Guernsey is the example we're going to use. It doesn't have any form of VAT regime. So if the place supplies Guernsey, that means there's no VAT on the service. That's a very important point. Of course, captives do exist in countries which do have a VAT regime. Malta in particular, Ireland is quite a common location for captives. And Switzerland also has a VAT regime, even though it's outside the EU. But again, the rates may well vary, so you need to consider these sort of points that we're talking about here, even if you are based in a VAT regime. So Martin, accounting for VAT.
So, as Peter said, different countries have different rates of VAT, and even within countries, say if you take the UK, there are different rates depending on the types of services or goods that are being supplied. And in the UK, the standard rate is 20%, but there's a reduced rate which would apply to certain types of services such as residential building works and goods, domestic fuels, heating products just carry a 5% reduced rate, and there's also a zero rate which would apply to certain types of food and drink, things like aircraft and ship manufacture. Other residential building works are zero rated, but as we said before, for insurance and other financial related products, the actual VAT rules are the supply is exempt, and that means that businesses which, for instance, businesses that supply zero rated goods are able to recover input tax, because even though their supply is zero rated, they're able to recover input tax that they incur. If you're an exempt supply, you can't recover input tax. So insurers have to suffer VAT costs when they're based within the EU, and for insurance companies that are based outside of the EU, so for instance captive insurers in Guernsey, because they are supplying insurance products into the UK which are exempt, they don't have to account for any VAT in terms of their premiums. But the benefit of being outside of the EU from a insurance company point of view is that you also don't necessarily have to incur VAT in relation to services that are being provided to the insurer, such as loss adjusting services or other types of services. The insurance company can avoid incurring VAT on those costs because the place of supply is actually outside of a VAT area. So it's quite important, and we'll come on to how this translates into different types of products and services that insurers can incur. But it's very important to make sure that the place of supply is quite clear as to whether it's a supply to the insurer or whether it's a supply to the insured.
Yeah, so some examples of how the place supply rules change the VAT treatment of supplies of goods or services. For goods, the place of supply rule is generally quite simple, and we're thinking here in the context of claims costs. So supplies of replacement goods, the place of supply is likely to be where the goods are at the time title transfers from the supplier to the customer, whoever the customer might be. So the question is, who should the customer be? If we've got a UK insured and a Guernsey insurer, either way, VAT is going to be payable because the goods, the replacement goods, are likely to remain in the UK where the insured is. He's the one that wants the goods, the replacement goods. So if the Guernsey insurer incurs the cost, the Guernsey insurer will incur the VAT as well, and that will be part of the claim. If the UK insured incurs the costs of the replacement goods, then maybe the UK insured is registered for VAT and can recover the VAT on those goods. So the claim then becomes the net cost and not the VAT inclusive cost. So the important thing is here, you need to structure it carefully so that you make sure the insured, if you can recover any of the VAT, is the recipient of the supply of the replacement goods and receives the invoice, of course, as well. So that entitles him to recover the VAT. For services, the rule is different because the basic place of supply rule for services, as I said, is where they are received. So if services are received, as Martin pointed out, by a Guernsey captive, they won't be subject to VAT. Problem is there are some exceptions to that basic rule for services, and the main exception that applies to insurance claims is land-related services. So if a building is damaged and has to be rebuilt, then if it's in the UK, and we assume it is in the UK because that's where the insured is, then it will be subject to UK VAT. And it doesn't matter whether the UK insured incurs that cost or the Guernsey captive, because it's an exception to the basic rule for place of supply services. It's always subject to UK VAT. So similar to goods, what you need to do is to try and make sure the services of rebuilding the building are supplied to the UK insured and not to the captive in Guernsey. So that the UK insured can then recover any VAT that he's entitled to. And if it's a UK trading group, then obviously that'll be 100%. And then that VAT doesn't form part of the cost. If it's only 50% recovery that he enjoys, then 50% of the VAT will be the cost, part of the claims cost. But you have at least reduced the claim. So basic rule service is, if the captive is in a VAT jurisdiction, you would have a place of supply where that is. So if it was Malta, for example, it would be subject to 18% VAT. So that would be things like repair to motor vehicle. That wouldn't be land related. Basic rule service, subject to VAT where received. If the contract for the repair is with the insurance company, that'll be Malta. Okay. And then you need to consider exemption for certain services. Claims handling in the UK at least is generally exempt. It does come down to how you define claims handling, because the services of a loss adjuster are not exempt generally. If the loss adjuster is acting as a claims handler, then potentially they can be exempt. And HMRC insists that the loss adjuster must be given the right to settle the claim or repudiate the claim before he falls into the exemption. But basically the services of a loss adjuster are valuation and not claims handling, and therefore they're taxable. But of course you then come back to the basic place of supply rule, if it's not a land-related loss adjusting service at least, and you say, well, where is the captive? Shall we have the charge there? If it's in Guernsey, we have no VAT. If it's in Malta, then we have 18%. If it's loss adjusting related to property, then it's going to be subject to that where the property belongs anyway, because again, it's land-related service. Okay.
So the things to consider when you're structuring a insurance policy are to, and especially when it comes to the claims handling, is to think about A, what type of claim it is, and then B, who should actually incur the cost of that claim. So an extended warranty policy, for instance, where the cost of the claim would be a repair cost, because that's a service, it would be better for a Guernsey insurer to incur that cost, because then the service can be provided VAT-free, because the place of supply is Guernsey and that doesn't have any VAT. But on the other hand, if the actual claim was either a property-related claim or a replacement of stock type of claim, then the insured should incur the cost directly, because the insured is more likely to be registered for VAT, and because those particular types of claims have to incur VAT, because these are places of suppliers in the UK for those goods, then the likelihood is that if the insured can recover the VAT, the claim can be net of VAT to the insurer. So again, that's the most efficient way of managing the insurance policy. In terms of claims handlers and loss adjusters, again, depending on the type of claim that is arising, if the claims handler or the loss adjusting is related to a property claim, then it's likely that you wouldn't be able to, that service wouldn't be able to avoid the VAT. So it would be better for that claim, the cost of that claims handler or loss adjuster to go to the insured. But if it is actually a loss adjusting in relation to a claim which isn't property related, so if it's, for instance, a valuation in relation to a repair cost, then that loss adjustment cost should be able to be directly supplied to the Guernsey insurer without VAT. So again, it's important to make sure that for the different types of claims and any related services, that the right counterparty is actually being invoiced, and the right level of VAT or lack of VAT is being applied. It will also obviously be important to ensure that the service provider is aware of the A, who they're supposed to be providing the service to, but B, they also have to be aware of the particular circumstances. So if they are providing a service to a Guernsey insurer, they shouldn't be charging VAT, because they should be aware that it's the place of supply rules mean that the supply is to a customer that is outside of the VAT regime. So it's very important to make sure the invoicing for those services is to the correct party.
Yeah, and it's important to say that invoicing should follow the contractual route. So before you get the invoicing right, you should make sure that the contractual arrangements for the service or the supply of goods that are the fulfilment of the claim is in the correct direction. In other words, the customer is the insured if you want it to be the insured to recover the VAT, or the insurance company if you want to avoid the VAT being charged in the first place for a basic rule service. Difficulty then arises because of this exception to the basic rule for place supply services. Land-related services are always subject to VAT where the land is. So you need to know what is land-related and what isn't. And that's not quite as easy as it might seem at first sight. Obviously, construction or repair of a building is going to be a land-related service. Similarly, surveying a building or assessing damage is going to be land-related. Valuing damage for insurance purposes, loss adjusting services related to a building are going to be land-related for VAT purposes as well. Legal services, if they relate to a specific building rather than general liability, are going to be land-related, and arranging for the sale or lease of land is land-related. Arranging hotel accommodation, maybe replacement accommodation, is not land-related, and advising on general land prices or markets is not land-related because it's not related to a specific area of land, it's more a market, you know, a whole town or something like that perhaps. And then finally, storage services, which is a very odd one. If storage services relate to a specific area of land, then they're land-related. But if it's storage services which involve just saying, well, I'll take your goods away, I'll store them, I'm not going to tell you where they are even, then that's not land-related. So somewhere in between those two extremes there is a dividing line. And there's always a grey area in VAT. So that's a very, very difficult one indeed.
So if we look at an example of a UK insured with a captive in Guernsey, and then we look at the different types of supply of goods or services to either the insured or the insurer, we can now see what the VAT position would be under different situations. So, for instance, if the UK insured owns UK property, any repairs to that UK property would be VATable whether the invoice is supplied to the insured directly or to the insurer, because property-related services will be VATable because of the location of the property. So there's no difference really. There's no difference there in terms of the level of VAT. But of course, from a claim point of view, it would be better for the invoice to go to the UK insured, because they're more likely to be registered for UK VAT and potentially be able to recover that VAT. Certainly the insurer in Guernsey wouldn't be registered for VAT. In terms of other repairs, so to other goods or motor vehicles, that kind of thing, again, if the supply was to the UK insured, it would be VATable because the UK insured obviously would be within the UK. Because the Guernsey insurer is located in a jurisdiction that doesn't have VAT, any supply of services, which would include repairs to non-land related goods, they would be VAT free. So in this case, if it was a motor vehicle repair, it would be better for that repair cost to go directly to the insurer, and for the invoice to also go directly to the insurer, so that they could then avoid the VAT altogether in relation to those repairs. Costs for other things like PI losses or liability claims, these are not good supplies of goods or services. This is a compensation for loss. So they should be VAT free regardless of whether it's the insured or the insurer that's paying them. But of course, if you think about things like claims handling or loss adjusting fees in relation to those losses, there might well be a difference depending on if it's the insurer in Guernsey that is paying for the loss adjusting. Then again, that is outside of the VAT regime, so that should make a difference. Supply of goods, stock or motor parts will be VATable because the goods won't be leaving the UK. There will be a supply from a UK supplier to the UK insured. So the cost will be VATable, and so in those situations it would be better for the insured to directly pay for those goods and to then recover the VAT for their own VAT return, and to claim from their insurer just the net amount. So the cost of supply net of VAT. And then, as I said, claims handling and loss adjusting. Claims handling is VAT free, assuming that there is actually a loss to handle, so an insurable loss. So again, the it shouldn't really matter whether it's the insured or the insurer that pays this, because the claims handling costs should be VAT free. But that's not the same as loss adjusting fees, where the loss adjusting service, rather than it being a insurance related thing, this service of loss adjusting will be VATable in the UK, because this place of supply will be to the UK, but again, to an insurer in Guernsey, the place of supply would be Guernsey. So the loss adjuster shouldn't be charging VAT if it's supplying services directly to the insurer, which would be the better route to go down, so long as it's not property related. If it's a property related loss, then they would have to charge VAT, in which case it would be better to charge the insured.
Okay, in terms of claims handling and loss adjusting, if we keep on with the example of Guernsey captive and UK insured, it's not quite as simple as saying that the claims handler should be billing the Guernsey captive. It may be more convenient to do it that way from a commercial perspective, but actually, although it falls within the exemption, if the claims handler bills the insured in the UK, then the supply of the claims handler will be exempt. If he bills the captive in Guernsey, it will actually be outside the scope of VAT with the right to input tax recovery. So it's an advantage for the claims handler to bill the captive in that example, rather than the insured. And that's moving this back one step. Whether you want to be kind to your claims handlers or not is another matter, of course. But they'll be keen probably to bill the insurer if possible. In terms of loss adjusting, as we've said, it's not insurance related, unless, as HMRC put it, you give the loss adjuster delegated authority to settle the claim, in which case what he's doing is acting as a claims handler, and the valuation service that he provides as part of operating as a claims handler is okay, that's part of the exempt service. So they are happy in that situation to allow exemption for loss adjusting as well. But it has to be a loss adjuster acting as a claims handler, basically, and he has to have written delegated authority to do that. So that's another way of getting exemption for certain insurance-related services. Okay, policy wording.
So the question really is how to ensure that that the right treatment is applied in any particular circumstance, and the answer really is to ensure that the policy wording, which is obviously the sort of starting point for any insurance coverage, is explicit as to how, if a loss arises, how that claim should be treated. And there's likely to be different policies depending on the different types of cover that are being provided by the insurer. So if it's a property insurance cover that the policy is providing, then the policy wording should specifically make it clear that the insurer, if it's a Guernsey insurer, should be indemnifying the UK policyholder for cost of repairs. And this is because the UK policyholder has the ability to recover the VAT, which will inevitably be charged in relation to any repairs or replacement goods in relation to the property. So it's important to ensure that the insurer is just indemnifying the UK for the cost of repairs, which will be net of VAT, plus any irrecoverable VAT. But if it's a motor own damage policy, then the policy wording should make it explicit that the insurer should both arrange and settle the repair costs directly with the repairers, because any repair costs in relation to motor vehicles can be levied directly to the insurer without any VAT attaching, because this is a service and the place of supply of that service is to the insurer in Guernsey. So it's possible for the UK insured, which owns the motor vehicle, to avoid the VAT altogether, as long as their insurer in Guernsey is actually the one that's settling directly with the repair company. But then finally, with with contents or stock insurance or any other supply of goods, where the goods make up the cost of the claim, where those goods are being supplied from a UK supplier to another UK insured, again the cost of that supply will include VAT. So again, the insurer should be indemnifying the UK parent as opposed to paying the cost directly, because the UK parent might well still be able to recover the VAT, whereas the Guernsey insurer wouldn't be able to recover that VAT, and so the insurer would be the insurance policy would be more effective by just indemnifying the UK parent for the net of VAT costs. It would actually provide more coverage and provide them with greater ability to recover more losses by just only incurring the costs net of VAT.
It's interesting actually on motor repairs that you may encounter difficulties in the UK in particular with making sure that the charge is non-VATable. Motor repairers will tend to want to charge VAT if they possibly can, and HMRC themselves will take the view initially that the supply is to the insured in the UK and therefore subject to VAT rather than the captive. So for motor repairs in particular, you will need to be very, very sure that you have a contract with the motor repairer, which is with the insurer and not with the insured, if you want to avoid the VAT cost. And even then, you'll have a long argument with the repairer, I'm quite sure, to persuade them that that is right, that there's no VAT on their charge. The reason why HMRC is so suspicious about this sort of scenario is that there was an avoidance scheme set up with Gibraltar to offshore motor repair services so as to avoid the VAT on the claims. And the case, I can mention the name of the insurer, it was WHA, Warranty Holdings, because there was a case which went as far as the European Court, which found that actually the structure they'd set up was successful, technically, in practice, but because of the anti-avoidance regime that we've got following another European Court case called Halifax, it could be done down. So it was the benefit that they managed to get from that avoidance technique was negated by the tax authorities.
We've actually got a client where they deliberately do pay VAT on motor repairs because actually even if you had an insurance policy insuring a motor repair, you'd have to pay IPT on that premium, which the insured would obviously not be able to recover. But if they can recover the VAT in relation to the claims costs, then it's better for them to do that than to pay the IPT. So actually, in some cases, it is worth paying VAT rather than having to incur IPT.
Yeah, yeah. And that's basically making insurance taxable.
Yeah.
Making it a warranty rather than an insurance contract is quite a common thing, particularly where higher rate IPT is concerned, where it's extended warranties for electrical goods and that sort of thing. Okay, property insurance. We've said that claims handling is VAT-free, exempt if place lies UK, outside the scope with recovery if not, but loss adjusting is VATable, always VATable, if it relates to UK property. So if it's just a valuation service, doesn't qualify as claims handling. If it relates to UK property, then VAT is going to have to be charged, whoever is the customer. So here, the insured should appoint the loss adjuster if possible. And this harks back to the policy wording. You need to think about this in advance, because if you restrict yourself to the insurer appointing the loss adjuster, that's the end of the matter. If the policy is pretty flexible and allows you to decide on a claim-by-claim basis who should appoint the loss adjuster, then that's a better answer, I think. And this was a point that was raised in the earlier session that we had. The answer probably is to make the policy as flexible as you can in the event of a claim, so that you can decide on the direction of supplies of goods or services, fulfilment or otherwise, related to that claim. Motor own damage, claims handling for that is going to be VAT-free again. Loss adjusting here is not land related, so if it's pure loss adjusting, it's going to be VAT-free as long as the Guernsey insurer is the customer. But if the UK policyholder is the customer, has appointed the loss adjuster, then potentially VAT is payable, which won't matter if the policyholder can recover all of the VAT, of course, but it does need to be taken into account if they can't, if they're partially exempt. And then claims handling for contents or stock insurance, supplies of goods. Again, this is going to be VAT-free if the supply is the Guernsey insurer, but it's going to be VATable if it's supplied to the UK insured. And again, if the UK insurer can recover all the VAT, there's no difference, but if there's a restriction on the recovery, then you ought to make the supply to the Guernsey insurer. Sorry, losing my voice there.
we've got a couple of practical examples which I'll quickly run through because they just sort of just put it into context. So the first example is of a UK printing company where it's got a Guernsey captive, and the captive is writing three covers, three policies. One is a property damage cover, one is an employer's liability cover, which is provided via a fronting company, and then there's a business interruption cover. So a particular incident occurs where an employee gets his tie stuck in the printing press, which causes extensive damage to the machine and injuring the employee, which obviously also gives rise to a business interruption loss as well. So all three policies are triggered in terms of claims, and the question really is how should these losses be treated by the insurer. So I'll just show the answer. So there's actually...
We decided earlier on that the printing press wasn't part of the land, so it's not a land-related service.
There's a bit of an error in here. Which it's a movable printing press. So assuming that the printing press is movable, then we're saying that any new parts for it potentially should be purchased by the parent company, because this would be a supply of goods which would be VATable, and the parent company would potentially be able to recover the VAT through their VAT return. But any repairs to the machine, assuming it is a movable machine, would be better incurred by the insurance company, because the cost of repair would be a service. In more likelihood, obviously, it probably wouldn't be a movable machine, it would be sort of bolted down, in which case it would be a property-related loss. So the opposite would be true, and the UK insured should actually pay for all the liabilities in relation to the cost of the repair and the replacement parts. But assuming it was movable, then it would be better for the insurance company to pay. The employer's liability claim, this is obviously a compensation loss to the employee who got injured, but actually any loss adjusting or medical examination cost in relation to the claim would be better borne by the insurer, because that would be a supply of services which, if it was made to the insurer, would be to a place of supply outside of the UK VAT network. And same for the business interruption. Any loss adjusted costs would be better borne by the insurer, because again, even though it's a compensation claim, the loss adjusted costs would be VAT free if it was to a place of supply outside of the UK. Quickly run through the second example, which is an example of a chain of restaurants, called Jolly Eater, and they've got a captive called Chips Insurance. So the insurance company in this case is writing three different policies: a property and contents insurance, a public liability cover, and a business interruption cover again. And again, in this case, so there's a fire broke out in one of their branches, causing extensive damage. Luckily nobody was injured, but there was damage to the property and to the kitchen equipment, and of course repair and decorating costs were also incurred. And so the question is, how would the claim be handled? And so taking each one in turn, damage to property, obviously property repair costs in the UK are VATable regardless of who bears the costs. So in this case it would be better for the parent company to actually incur the costs and recover the VAT through their VAT return. Then the claim to the insurance company can be net of the VAT costs plus any irrecoverable VAT. And that would also be the same for the loss adjuster's costs, because the loss adjuster would be adjusting a property related claim. In terms of damage to kitchen equipment, again, if depending on whether the kitchen equipment was bolted down, assuming it wasn't, then any replacement equipment would be a supply of goods. So that would obviously be a supply to a UK insured from a UK supplier, and again that would be VATable. So in this case the parent company would be better to incur the cost and then recover the VAT through their return. But any repairs to particular equipment might well be able to be incurred through the insurer. But actually in most likelihood, kitchen equipment which isn't bolted down, it's either going to be written off or it's going to be not damaged at all probably, so it'll be a supply of goods. And then repairs and decorating costs, this is a land-related service, and so it will be subject to UK VAT. But interestingly, in this case, obviously the cover which is being provided is property and contents insurance of up to 200k, and so in this case we would actually be going above the limit of cover. So you have to be careful to make sure that in relation to the repairs and decorating costs, which would incur VAT, if Jolly Eater PLC were incurring those costs, they wouldn't be able to necessarily recover the full costs through the insurer. They'd be able to recover all their VAT potentially, but they'd have to be careful to apportion those losses to the insurer so that they weren't trying to over recover under a policy which was obviously be fully expired. So that's our practical examples. And then
so can we just ask, in the event of the claim, this is possibly a very good question, if you had a flexible policy wording, who would make the decisions? The insurer would make the decisions, the captive would say who should pay for what repairs?
most likely it would be the insured that would make the decision, especially in relation to a captive, because they obviously are the primary insurer. They're the insured person, so it's up to them whether they make a claim or not. And in this case, they would have to pay for the repairs anyway, so they would still have to incur the cost of repair, and it's up to them really how they then applied for reimbursement of part or all of those costs through their captive. What they would probably want to do in this case is to make sure that where the insurer was able to incur the costs without VAT, that the insurer did actually incur all those costs, such that it was able to avoid VAT where possible. And in relation to those costs that would be better borne by the parent, which would then be the ones that would have VAT included, they would then recover those VAT costs and then apportion those costs depending on what they thought was the most appropriate apportionment of where the insurance policy would be triggered. But it will probably be down to the insurer themselves, the insured themselves, as to how they apportion them.
And would you see this happen with a general insurer?
Yeah, the general insurer is likely to have more control over what happens with the claim, I would suggest. So it may well come down to the insurer rather than the insured in that scenario.
Yeah.
But they would apply different rules for different...
Yeah, potentially. The strange thing in the UK is for motor claims in particular, HMRC make the assumption that the supply is to the policyholder. And it doesn't really matter how you set up the contract, they will always default to that position.
Right.
So that's another reason why I say it's difficult to change that and have it supply to the insurer in Guernsey. It's achievable, but you'll encounter obstacles with certainly the repairer and probably HMRC if they get involved as well.
Yeah.
Okay, so just very briefly in summary, because we need to get back to the main session. I think what we've shown is that you need to consider the different types of supplies of goods or services which comprise your claim or which are associated with your claim, and look at whether you can get exemption for claims handling in the UK in particular. If you are in Ireland or in Malta or in Switzerland, you'll need to consider the VAT regimes in those countries. But of course we've been talking about Guernsey, so we haven't had to worry about the insurer country's VAT regime, because there just isn't one. But in summary, really, you need to look at who is paying for the losses, and in particular, who is contracting for the supply. And I think that was your question earlier on with regard to an Italian claims handler. Who is actually contracting for the claims fulfillment supplies? As the third-party supplier making the supply to the claims handler, to the insurer, to the insured. And it's important to understand what the contractual relationships are, even if they're not in writing. So who has appointed that claims fulfillment provider, and who therefore is receiving the service? And then after that, you make sure that the invoice is given to that customer and not to someone else, which can happen in practice. And that confuses the issue. And once you've decided what the contractual position is, you can of course decide on whether VAT is chargeable or in which country it's chargeable. Okay, that concludes this session. Anybody got any more questions? Good, thank you for coming along.
Thank you very much.